I have been sitting on this topic for a while, and the reason I kept putting it off is not because I was afraid to say it. It is because I wanted to make sure that when I did say it, I had every piece of the picture assembled correctly. Because this is one of those topics where the emotional stakes are high, where a lot of people have built part of their investment thesis around a specific narrative, and where the honest answer is genuinely more complicated than the version being sold on most content. So today we are talking about dark pools. We are going to go through exactly what they are not, why the version of this story that has been circulating in the XRP community is partly right and significantly wrong in the ways that matter most, and what the actual picture looks like when you strip away the hype and read the real data. And I want to be transparent with you before we start. What I am about to say is not going to confirm the $10,000 XRP thesis, but it is going to give you a significantly more accurate mental model for why price has not moved despite genuine institutional interest, and why that disconnect actually resolves in a way that is still constructive for long-term XRP holders, just not through the mechanism most people think. If you appreciate content that tells you the honest answer instead of the comfortable answer, hit the like button right now and subscribe before we go any further, because this channel is built on one thing and one thing only, and that is telling you what is actually happening. Let's get into it. Before we get into dark pools specifically, I need to cover 3 announcements that dropped this week because they are directly relevant to the broader XRP thesis, and honestly, they have been getting buried under the noise. The first one is XLS 100. Smart escrows are now live on the XRP ledger. And I know the instinct for a lot of people watching this is to tune out the moment I say the word amendment, because it feels like technical news that does not move price. But stay with me for 60 seconds on this one, because the XLS 100 change is not small. Under the existing escrow system on XRPL, escrows are rigid. You lock XRP until a specific date, or you release it when a predefined cryptographic condition is met. That is it. Clean, simple, but not flexible enough for the real-world use cases that institutions actually need. Smart escrows change that completely. At the core of XLS 100 is a small piece of WebAssembly code attached to each escrow that runs when someone tries to release the funds and decides whether the conditions are actually satisfied. That code can be written by any developer. It can say, release these funds when XRP hits a specific price, or when a KYC compliance check clears, or when both counterparties have digitally confirmed the terms of a deal, or when an oracle confirms that a real-world event occurred. This is programmable logic built directly into the XRP ledger itself, without needing a full smart contract layer sitting on top of it. For institutions handling cross-border payments, for companies managing milestone-based contracts, for RWA platforms that need compliance holds before assets can move, this amendment turns the XRP ledger into infrastructure that can handle those workflows natively. It is one of those changes that looks small in a headline and is enormous in its downstream applications. Comment "Smart Escrows" below if you have been tracking the XRPL amendment roadmap, because I want to know how many people in this community are watching the protocol layer, not just the price chart. The second announcement is Evernorth. If you are not familiar, Evernorth Holdings is the XRP treasury company preparing to list on NASDAQ under the ticker XRPN. This is a company building a publicly traded equity vehicle that gives traditional investors structured exposure to XRP without needing a wallet, without private keys, without an exchange account. Just a NASDAQ-traded stock backed by a treasury of XRP, the same model that MicroStrategy used for Bitcoin, applied to XRP for the first time. This week, Evernorth nominated Ripple's chief legal officer, Stuart Alderoty, to its board of directors. Let me be precise about what that name means in context. Stuart Alderoty is the person who led Ripple through the most consequential legal battle in the history of the digital asset industry. He is the reason that programmatic sales of XRP were established as non-securities transactions in federal court. He is the most credible voice on XRP regulatory compliance in the world, and he just joined the board of the company that is building the first publicly listed XRP treasury vehicle on NASDAQ. That is not a routine board appointment. That is a signal from within Ripple's own leadership structure that they are actively supporting the institutional equity infrastructure being built around XRP. The CEO of Evernorth, Ashish Birla, is a former Ripple executive. The CLO is now on the board. Every major player tied to Evernorth has a direct Ripple connection, and that density of insider involvement tells you something very specific about the level of confidence that exists inside the XRP ecosystem about where this is heading. Evernorth going live on NASDAQ with that lineup means traditional investors who cannot or will not hold crypto directly now have a regulated, familiar vehicle for XRP exposure. That is a new pool of capital that did not exist before. The third announcement ties directly into why institutional adoption of XRP is accelerating regardless of price. Ripple Treasury, the product that embeds digital asset management natively into existing treasury management systems, just got highlighted again this week in the context of a survey showing that 72% of global finance leaders believe digital asset solutions are necessary to remain competitive. Not 20%, not 40%. 72% of people running banks, asset managers, fintechs, and corporate treasury departments are telling you that digital assets are not optional for their business model going forward. And the gap identified in that survey, most do not know where to start, is the exact gap that Ripple Treasury is designed to close. No new workflows, no separate custody setup, digital assets embedded directly into the systems these institutions already use every day. That combination, 72% of finance leaders acknowledging the need, a ready-made enterprise product from the most regulated and compliance-ready company in the space, is the demand picture underneath the price chart that the war headlines and oil coverage are completely obscuring right now. Now, dark pools. Let's build this correctly from the beginning because there are two completely different versions of this narrative running simultaneously in the XRP community, and only one of them is accurate. Version 1 is what most content on this topic describes, a secret private XRP ledger where thousands of institutional players are moving trillions of dollars in XRP transactions every single day, completely off-chain, and once that volume migrates to the public ledger, XRP's price explodes to 5 figures. Version 2 is what dark pools actually are. Private electronic trading venues and OTC desks, where large institutional orders are executed off public exchanges in order to minimize market impact and get better pricing on large block trades. Those two things sound vaguely similar when you say them out loud, but they are fundamentally different in their implications for XRP price. And understanding the difference is the most important thing I can give you in this video. Let me start with what dark pools actually are, because the mechanics matter. When Bitwise receives $100 million in new ETF inflows and needs to buy $100 million worth of XRP, they do not go to Coinbase or Binance and drop a $100 million market order. If they did that, the order would move the price significantly during execution. They would be buying at progressively higher prices and signaling to the entire market that a massive buyer is entering. Instead, they go to 7 major institutional market makers: Jane Street, Susquehanna, Goldman Sachs, Macquarie, Virtu, and others. Request competing quotes on the full $100 million block. Negotiate the spread down as far as possible, select the winner, and execute the full trade at once. The market maker who wins then goes out and sources the XRP through their own liquidity network, which may include exchanges, OTC desks, or dark pool venues. But the key point is that none of this shows up as a visible order on public exchange order books until the market maker executes their hedge. By the time any price pressure from that purchase reaches the public market, it has been spread across multiple venues, multiple time windows, and multiple liquidity sources, specifically to minimize its impact. That is why $120 million in XRP ETF inflows in a single week, which represented over 50% of total crypto ETP inflows of $224 million, the largest weekly XRP inflow since December 2025, did not immediately translate into a visible price spike on the chart. The buying happened. It was real. It moved through the system. But it moved through the system in the way that all institutional scale capital moves, through mechanisms specifically engineered to not be visible on a price chart in real time. Now here is the important distinction I need you to hold. The OTC desks and institutional trading infrastructure that handle this kind of volume are real. Kraken's dark pool is real. Ripple Prime is real. Coinbase Prime is real. Cumberland DRW is real. FalconX is real. B2C2 is real. These are legitimate, documented, operational trading venues. They process enormous volumes of crypto trades every day without that volume appearing on public exchange order books. Institutional demand is draining OTC XRP supply in a documented and measurable way, with estimates suggesting only 1 to 2 billion XRP remain available in these venues, with 800 million already consumed in the first week after multiple XRP spot ETFs launched simultaneously. That supply compression is real, and it matters for what happens when public market demand accelerates. But, and this is the part I need to be precise about, none of that is the same thing as a secret parallel XRP ledger where trillions of institutional transactions are happening every single day and waiting to migrate to the public chain. That specific version of the narrative does not have documented evidence supporting it. And David Schwartz, Ripple's own CTO, the most technically credible voice on what is actually happening on the XRP ledger, said it explicitly in a post from July 2025 that I think most people read without fully absorbing what it meant. He acknowledged directly that most of the digital asset use connected to XRP's 300-plus bank partnerships has happened off-chain. Institutional players, including Ripple itself, have not been using the XRP ledger DEX for most of that activity. The infrastructure for them to do so has not been fully in place. Read that twice. This is Ripple's CTO telling you that the on-chain volume most XRP holders have been expecting to see has not materialized yet. Not because something is broken, not because the banks are lying, but because the amendments enabling institutional-grade on-chain use have only recently gone live. The SEC lawsuit created legal uncertainty that made large institutions reluctant to commit capital to on-chain activity. The amendment suite was not complete. Regulatory clarity was not in place. And now, one by one, every single one of those barriers is being removed. XLS 100 smart escrows live. XRP classified as a digital commodity by both the SEC and the CFTC. Evernorth heading to NASDAQ. Ripple Treasury embedded in institutional TMS platforms. The Clarity Act in its most critical legislative window, and Morgan Stanley, $1.9 trillion in assets under management, publicly stated they are turning on their own dark pools to support tokenized equities by end of 2026. That is not a crypto-native company. That is the traditional financial system building the private institutional trading infrastructure for digital assets using the same model the crypto community has been discussing for years. Here is the honest verdict on the dark pool narrative, and I am going to give it to you straight. Is there significant off-exchange XRP trading happening right now through OTC desks and institutional venues that does not show up on public price charts? Yes, absolutely, and the data supports it. Is that the reason XRP has not gone parabolic despite genuine institutional interest? Partially, the OTC buying mechanism genuinely does suppress visible price impact during large accumulation phases. Is there a secret parallel XRP ledger with trillions in daily transaction volume waiting to flip public and send XRP to 5 figures? No, that specific version is not supported by any documented evidence, and it contradicts what Ripple's own technical leadership has said about where on-chain volume actually stands. What is actually building, and what the XLS 100 amendment, the Evernorth NASDAQ listing, the Clarity Act timeline, and the Ripple Treasury product represent, is the systematic removal of every barrier that has prevented institutional on-chain use from materializing. The legal clarity barrier is almost gone. The technical amendment suite is nearly complete. The regulatory framework is approaching its final passage window. When those barriers are fully removed and on-chain volume still does not materialize, I will be the first one to tell you something is wrong, something was misrepresented, and the thesis needs to be reassessed. That is a commitment I make to you on every video, but we are not at that test yet. The barriers are still coming down. The infrastructure is still being built. The OTC supply is being drained faster than it can be replenished. And the amendments that enable real institutional on-chain use are going live one by one in real time. The honest read is not that the dark pool narrative is entirely fake. The honest read is that the mechanism is real, but the scale and the timeline being claimed are not. And that distinction matters enormously for how you manage your expectations and your position through the noise. Here is what I need you to take from this video. Dark pools are OTC desks and private institutional trading venues, not a secret parallel XRP ledger. The ETF inflows are real, the OTC buying is real, and the supply compression it is creating is real. The reason that institutional use has not shown up in on-chain volume yet is exactly what Ripple's own CTO told you. The infrastructure has not been fully in place until now. XLS 100 smart escrows are live. Evernorth is heading to NASDAQ with Ripple's CLO on the board. 72% of global finance leaders are on record saying digital asset solutions are not optional. Ripple Treasury is ready to onboard them. Every obstacle that has suppressed institutional on-chain activity is being cleared systematically. When they are all cleared and nothing moves, then we have a problem. Until then, the structure is building exactly the way it should. Drop a comment below and tell me honestly, were you in the camp that believed the secret parallel ledger version of this story? Or were you already thinking of it as OTC infrastructure? Because I genuinely want to see where this community's understanding is on this specific question. If this video gave you more clarity than you had before you clicked play, smash the like button. It takes 1 second, and it helps this reach the people who need the honest version of this story the most. Subscribe and hit the bell, because when the Clarity Act moves through committee, I will have the live structural breakdown of exactly what it means for XRP on-chain volume. And that is the video that connects every piece of this story together. I will see you there.